I'm Brian Cordes, head of the Portfolio Specialist Group here at Cohen & Steers. U.S. REITs have endured a challenging year in 2020 as some of the businesses in the economy that have been most negatively impacted by COVID-19 have in fact been forms of real estate: hotels, malls, shopping centers, and office. However, it hasn't all been negative. In fact, some property types have been experiencing accelerating demand: data centers, cell towers, industrial, and self-storage. And with the exception of retail, virtually all property types have been collecting at least 90% of the rent. And REIT earnings have proven durable as well, with losses expected to be roughly half those of the S&P 500 when all is said and done. Despite this, though, here at the end of November, REITs do remain negative for the year, and they've meaningfully underperformed the broad equity market. However, as we inch closer to 2021, we do believe U.S. REITs provide a compelling investment opportunity for three reasons. First, a vaccine-driven recovery. Second, where we are in the economic cycle. And third, attractive relative value. I'll touch on each of these now in a little bit more detail. First, with regards to the vaccine, the positive news from Pfizer and Moderna on the high efficacy rates of their vaccine candidates may serve as a catalyst to improved REIT performance. A viable vaccine can pave the way back to normalcy for businesses and consumers and allow REITs to improve upon this year's results. In addition, we believe it's reasonable to think that those that have been most negatively impacted by COVID-19 stand to benefit the most from a vaccine. So while cases have been spiking here recently, and that has led many to think of a dark winter ahead, we believe investors may look through this, look at the vaccine news as being a light at the end of the tunnel. Second, where we are in the economic cycle. We've moved through the recessionary phase quite rapidly, and we now find ourselves in the early stages of economic recovery. Historically, early cycle periods exhibit low interest rates, like we have today, and improving real estate fundamentals, which we have already started to see. In addition, historically, REITs have posted their best performance in these early cycle periods. Looking at data going back to 1991, we find that during these early cycle periods, REITs have posted an average annualized return of 23% versus only 11% for the S&P 500. In addition, given the meaningful underperformance here recently versus the equity market, we believe this could potentially provide additional room to run for the REIT market. Third, relative value. REITs today offer historic levels of relative value both versus equities and fixed income. In looking at earnings multiples of REITs versus equities, we see that REITs are currently trading 6 turns cheaper than the broad equity market. That is a level that we have witnessed only twice before in the last 18 years. When assessing relative value versus fixed income, we can look at a yield spread. We look at a spread between the implied REIT cap rate versus a BBB corporate bond yield. Today, that spread sits at 320 basis points. Historically, that spread has only averaged 190. So with spreads being meaningfully wider today than what they've been historically, this is an indication of good relative value with REITs. In fact, only once before in the last 20 years have we seen spreads reach the levels that they are at today. So in summary, we believe U.S. REITs are in a strong position as we head towards 2021. Just as COVID-19 upended the REIT market in 2020, we believe the REIT market can benefit from a vaccine and an economic recovery, all while trading at attractive levels of relative value versus both equities and fixed income.